Alright, so today I wanted to make a video on a couple of semiconductor stocks. Both of them I do have positions in. Neither one of them is too large. And both of them I do want to increase that position. So the first one is Lam Research. Again, they're both large cap companies. I think actually very similar size. $127 billion company. Again, Lam Research free cash flow yield about 3.8%. So again, I would like that to be a little bit higher. But it is not terrible by any means. Again, 0.82% dividend yield. Let's get right into the insights here. Again, I'll get into the dividend later. Again, analysts moderately bullish. Currently I think that the stock is definitely a little bit overvalued, but long term I think it's going to do just fine. Again, the current growth is definitely a little bit concerning, but keep in mind this company still is growing decently. Again, one commonality of these companies, both of them have very, very good balance sheets, which I think is going to be a very important part of investing going forward. With rates being higher, that means that companies are paying more for their debt. And the companies that have the strongest balance sheets are going to be the ones that are going to do the best because they're going to be the ones least affected by the higher rates. Not perfectly correlated, but again, there's going to be a pretty clear correlation here. So again, current ratio of over 3 is extremely good. They're buying back shares. Their cash is easily more than their liabilities, basically meaning if they wanted to pay off all their debt tomorrow, they could do it just with the cash they have on the balance sheet, which is again another example of a very good company. Again, profitability, they are extremely profitable, which is something you love to see. A free cash flow margin of 33% is very good. That's phenomenal. Management, again, also does a very good job here. Return on invested capital, 47% is, again, also extremely good. Like that's phenomenal, good numbers there. Again, like I said, it is overvalued, but I don't think it's crazy overvalued. I bought this company at probably $500. It might even have been in the 400s. Again, it's just under 1,000 right now. I wish I would have bought more. Once it ran up over like 600, I remember thinking, oh, yep, I'm going to have to wait for a pullback. Again, it has not pulled back since. So if we get, I would say anything more than like a 5, for sure 10% pullback here, that's when I would start getting in again. I wouldn't take a massive position. I would simply dollar cost average. But again, that's just my opinion here. Again, it is, as far as free cash flow, it is 19% above its historical average. So you say, oh, 10% is enough. Again, I think a 21 price to free cash flow or 22 price to free cash flow, honestly, that's probably a little bit undervalued if you ask me, based on current levels of earnings. And again, that's one problem with trying to come up with valuations is that, again, if the earnings go up, okay, well, it's going to look cheaper. If earnings go down, it's going to look more expensive. So that's one thing you got to keep in mind is that whenever you're coming up with these valuation models, it is just an educated guess. It's never going to be exact. Price to sales of 8.9, that is definitely expensive. A price to sales of 4.77 is the average. Again, I would say that's probably about fair, maybe around 5, maybe 6 at the most. So again, you definitely do want to pull back before you're going to get in here, but I don't think it's as much as what a lot of people would guess. Again, if we look at the financials here, again, this is the bread and butter of looking into stocks right here. Again, one thing you'll quickly notice, like I pointed out, liabilities of only $10.5 billion. Again, this is a $127 billion company, right? So that's very good to have that little debt on that high of a market cap. That's one of the things you really like to see. Again, look at the diluted shares outstanding here. Again, ever since 2017, they've been buying back shares consistently. They had 184 million shares outstanding in the middle of 2017. They're down to 136, right? That is like probably 20% over whatever that is, 6 or 7 years. That's very, very good. I think that's probably about 3% per year right there. So again, very, very good numbers there. If they can continue buying back 3% of shares per year, that is absolutely amazing. Even if that number goes down to 2, I would still be very happy with that. Again, earnings. Look at how fast this company has grown earnings here. I mean, back in 2013, their earnings was 0.66 per share. 2023, 33. That is what, 100x? My math might be off there, but either way, phenomenal growth, like absolutely phenomenal growth. They are not going to grow this fast over the next decade, but I do still think they have room to run here. If we look at net income, again, also very, very good growth there. If we go over to the metrics here, again, this is another area where this company really shines. Again, operating cash flow margin has been at least 18% going back to 2016, which is very, very good, very strong profitability. If we look at the return on equity, again, return on equity has been, 54%, 73%, 64%, 43, 46, 36, like extremely good numbers there. Return on invested capital, also very, very good. If we look at its free cash flow per share, again, look at the growth here. Extremely good. 2023, they probably did over-earn a little bit. But, like I said, I think that the trend is still going to be up over the long run. Again, the last thing here, actually there's going to be one more, the dividend. Again, another thing that's very, very good. Again, only 0.82%, but they're growing at 12.7% per year, which is what I love. Again, if you'd have bought this company a decade ago, you'd have a 15% yield on cost, which again is exactly the kind of dividend investing that I like, because not only do you get the growth, you also get the dividend. The problem with people that buy the old guard, like your AT&Ts and those kind of companies, is okay, yeah, you get a 6, 7, 8% yield, but you get no growth. Why not just defer your gratification, buy the companies that are growing their dividends, and you get the growth and you get the dividend? You just have to grit your teeth for a decade. That's my philosophy. So again, the next one here is AMAT. This one I don't have quite as large of a position in, but that's because I don't think it's ran up as high as Lam Research has over the last year or two. So again, $171 billion company, 0.78% dividend yield. Again, the free cash flow yield is about 4.5 on this one, which definitely is a little bit better. Again, similar company, not exactly the same, but they are both in the semiconductor industry. Again, analysts not quite as bullish for AMAT as Lam Research. Earnings are actually projected to come down a little bit next year. Financial health, very, very good. Current ratio 2.71. Also have more cash than liabilities, which is very important, very good to see. Growth, pretty solid there. Management, again, doing a very good job. Return on invested capital, 41%. That's very good. Free cash flow margin, 29%. Again, not quite as good, but still very, very good. Again, this one does trade a little bit cheaper. Again, it's actually only slightly above its historical averages. Again, 5-year average, 20.2 price to free cash flow. It's currently at 22.3. This one, honestly, if this one hits the 50-day moving average, I'm going to start buying. I'm going to start buying because I think it's only slightly overvalued where it's at right now. So again, if we hit the 50-day moving average, off the top of my head, I honestly do not know where that is. If we look at the chart here, it's probably like it's going to be in the 190s, more almost, well, maybe 180s, but 180s, 190s. So if it hit, let's say 190, 195. Again, just ballpark numbers here. I'm going to start buying this because, again, I don't think you're going to get phenomenal growth out of either of these companies, but what you are going to get is companies that are going to buy back shares consistently, which is going to be value to you as a shareholder. They're going to grow that dividend very, very nicely. Again, if we look at this company here, they're growing at about 10% per year. Payout ratio is only 18%. They're going to keep growing that very, very nicely over time. I mean, they just raised it very, very nicely for the next quarter, then the next X dividend. They raised it from 32 cents to 40 cents, which is, again, that's very good growth. That's very good growth. Again, this company also, you'd have a 8.5% yield if you bought it a decade ago. So again, these are the kind of companies that I really like. Dividend growth. They're in companies where the demand is going to continue to go up. I still love the semiconductor industry. I think you have to be careful that a lot of these companies are very overvalued, and you also have to keep in mind that a lot of these companies are either barely profitable or not profitable, or they trade at egregious valuations, like NVIDIA. that's something you have to keep in mind. But if you can find the value plays in the semiconductor industry, I think those are going to be very, very good performers over the next decade or two, because that's an industry where the demand is only going to go up. And if you can find the deals there, you're going to make a lot of money, in my opinion. So let's check out the balance sheet quick here. Again, diluted shares outstanding here. They're buying back shares very, very nicely here. I mean, look at. I mean, actually, virtually every single year they have. But I mean, if we go back to 2013, 1.3 billion shares outstanding. They're down to 845. That's like what, 35% in a decade. That's about 3% a year again. So again, that is exactly what I like to see here. Again, if we look at its earnings per share, again, very, very good. 2013, 0.21. 2023, 8.1. So again, that's exactly what we want to see here. If we look at the metrics here, again, another very important indicator, operating cash flow margin was 32% last year. That is abnormally high, which is why this is one of the reasons why it looks like earnings are projected to go down, because historically they've been between about 20 and 26% for the last 7 or 8 years. If we look at its return on equity, that actually, and return on invested capital, that actually went down slightly year over year. But again, both of those numbers are pretty in line with averages. Operating cash flow per share, again, this is, free cash flow per share. Operating cash flow, important as well. But free cash flow per share, I think, is one of the holy grails of investing, is that if you can find companies that are consistently growing this number, again, that is one of the holy grails of investing. And again, if you see this company over the last decade, they've grown absolutely phenomenally. So that is that. Let's get into the actual growth rates here. So again, if we look at earnings per share over the last decade or so, Lam Research, actually AMAT has grown quicker, 27% versus 23%. Free cash flow per share, Lam Research has grown quicker, which is, I think, the number that is the most important here, 32 versus 27.8. Operating cash flow, again, Lam Research grew a little bit quicker again. If we look at the valuations here, again, this is another very important thing for people to understand, is that a lot of companies out there, the increase in share price is driven largely by people simply paying more for X number of earnings. Again, a lot of the tech companies, this is what you will see. So this is a metric that you really want to keep an eye on. So again, price to free cash flow compound growth rate. Both of these companies, the actual valuation has only grown a little more than 1% per year, meaning people are not simply paying more for X number of earnings, which is something you really want to see, because a lot of these companies, they'll be growing free cash flow or earnings, whatever number you want to call it, at 20% per year. But the compounded annual growth rate to the price of free cash flow is like 15% or 20%, meaning virtually all of the increase in share price is due to people simply paying more. So that's something you really want to keep an eye on. Both of these stocks, very good job of that. Again, price to free cash flow, Lam Research historically trades a little bit more expensive. Currently trades a little bit more expensive. Historically, they're almost exactly the same. 20.9 versus 20.5. Very interesting there. So again, based on the data, like I said, and like my research shows, AMAT, I think, is a 5-10% pullback. I'm going to be all over it. I wouldn't say all over it. If we got like a 15 or 20, then I would be all over it. Lam Research, we're probably going to need 10, 15, maybe 20% before I would start buying. So if you want exact numbers, again, just my guess, do your own research. Lam Research, we're probably looking at, it's currently around 950. We probably would have to go down to about 800, low 800s for sure. If it went below 800, then I would start to get really interested. AMAT, I think probably like 190, even 195. I probably would start buying. If it went into the 180s or even lower than that, that's when I would become really interested. So again, that is my analysis of these two stocks. I think that these are both phenomenal companies. The one thing you have to keep in mind, both of these are large cap companies, and a lot of new and even intermediate, honestly, virtually all investors, to be honest, are overexposed to large cap companies because they just buy the S&P and go away or whatever. So you want to keep in mind, you definitely do not want to be overexposed, which is why I like owning like 50, 60 companies, because it's a lot easier to diversify then. It's a lot easier to add the small caps and the mid caps, because honestly, I'm still probably a little bit overexposed to large cap companies. But that's why I like owning more stocks, because then you can diversify easier. Again, just my opinion there. Everything here, obviously, my opinion. Do your own research. So again, if you like the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.